We've mentioned FOOP before.
Yes.
Fear of overpaying.
Fear of overpaying.
And FOMO, fear of missing out.
Yes.
And it's tilting again, isn't it?
It really is. It's just sort of like someone's jumped off the seesaw. It's gone boom. All of a sudden.
Hi, I'm Mehran Zareian.
I'm Glenn Stanley.
And we're Property Espresso. Glenn, we've been talking like this for months and months about the OCR, and it finally happened.
It happened. It's like all Christmases came early.
Yeah?
Or did they? Yeah, it has happened. 25 basis points, 0.25% off the 5.5% cash rate, which we've not seen a cut since 2020. 4 years we've been waiting for a cut. And it's finally happened.
Yeah. And it's happened a lot sooner than they said it was going to happen.
Yes, it certainly has. A lot of economists had picked November's cash rate review for the cut. Some had said October. You'll recall when we last caught up, I suggested perhaps August. Pretty happy with that punt. Shame I didn't put any money on it, but
well, you got your finger on the pulse.
I did indeed get my finger on the pulse, and it has. It's seemingly overnight. It's just transformed the sentiment out there. We saw ASB were the first to cut their interest rates. They cut every single rate that they offer. Some by 0.1, 0.15, some by as much as 0.35. But other banks have of course followed suit, and the phone's just been ringing, and Herald front page, the cash rate is down. It's we're about to get very busy, Mehran. It's good times.
Well, it's amazing what 0.25 makes a difference, isn't it?
Absolutely. Not just in terms of how much our repayments are when we have a mortgage. I mean, if your interest rate comes down by 0.25%, yes, it will free up a little bit of money or mean that you can pay your loan off faster. But also in terms of the test rate. The test rate is the rate at which the bank gauge how much you can comfortably borrow. So Kiwibank just today have reduced their test rate. They are the first of the banks to cut a test rate. They've come from 8.75 to 8.5%. What that means essentially is that any Kiwibank customer out there who has a standing approval for what they've been told is the most that they could possibly borrow based on their income is probably wrong. They can probably borrow more.
So it's good for first-time buyers.
It's ideal for first-time buyers. Along with a whole bunch of other policy changes that we've seen in the last 6-8 weeks or so. There have been subtle policy changes all designed to make borrowing and thus home ownership easier for those first-time buyers. It's great.
And it's come just before spring. And as we said the last time, we're going to be very busy.
Yes, indeed.
Because people are going to get more confident about taking action.
Absolutely. I was saying to someone earlier that it may not necessarily be this weekend that you have droves of new interest in your open homes simply because of the weather. I think you're probably going to see more people out and about this weekend, but as we start to see warmer, sunnier weekends, I think open homes are going to be a bit of a free-for-all. We're going to see more multi-offers. One of the things just to be aware of, and I think it is important that buyers, even vendors to some extent, do take into account, is that as inquiry volumes elevate, turnaround times at the banks get a bit longer.
Right.
I was talking to another real estate agent a short while ago, suggesting that the days of a 5-day finance clause for someone that doesn't actually hold a pre-approval are just gone. 10 days, even 15 days if possible, because some banks are saying it's 9 days, working days, before we can pick up an application. A couple of days to assess, and if they need evaluation, that sort of thing.
So I guess from the perspective of somebody that's looking to buy at auction, they would need that pre-approval before they bid.
Absolutely. I mean, most pre-approvals, when we talk a generic pre-approval, it's valid for up to 3 months, 90 days after which we can generally extend for another 3 months without too much ado. Beyond 6 months, it might require a new application, but the pre-approval itself is normally subject to 1 or 2 conditions. And that's the problem that we encounter with auctions, is that if my pre-approval states that I am required to get a valuation, for example, or a building report, or it's conditional on, I don't know, another property being sold. Yes, it's nice to know that we can borrow that money if the stars align, but it doesn't necessarily mean that we can put our hand up and bid at auction. Most of my clients who are interested in bidding for a property at auction, I will obviously get them pre-approved so that they can go out shopping for any house that they find. But once there's one identified that they genuinely want to bid on, we'll do all that we can to get those conditions tidied up so that they can bid, including making sure that there's enough money to pay the deposit on auction day. Because a lot of the time we get so caught up in these bits and pieces that we fail to go, oh, hang on, I don't have access. I mean, it might be in KiwiSaver, for example.
True.
How are we going to cover the deposit?
So they'd need to do some sort of variation before the auction.
Potentially.
And that needs to happen a couple of days before the auction to get everybody's signature on it.
9 times out of 10, there's no issues there.
Yeah.
I mean, we often suggest inquiring as to whether paying a 5% deposit rather than a 10% deposit is acceptable. And again, most of the time it is, so long as we get it in early, we get our request in early. You might find that there's a number of variations. If you have a property with a number of interested parties, they all might have their own little quirks and so on that they need to just ensure that that's going to be viable. There's nothing worse than someone bidding, winning, and then going, oh wait, yes, no, I don't have a deposit to pay.
So can the banks do the valuation online?
There are, most banks use their own sort of proprietary valuation service. There are independent third-party valuation services that I have accounts with and can get those. Depending on the nature of the property, the nature of the transaction, the age of the property, and whether or not the algorithm picks the value to be within a range or another wider range. Sometimes these online free valuations work, sometimes they don't.
Right.
Sometimes they give us cause to actually, engage with a professional registered valuer who will come out and physically inspect the property and can arguably provide a more reliable report.
Yeah.
But I mean, mostly these sorts of valuations are only required for borrowers who need more than 80%, need to borrow more than 80% of the value, or oftentimes what we call shoebox apartments, so non-standard apartments, some cross-lease titles, that sort of thing. Normally a straightforward, brick and tile on a freehold property, and we're borrowing under 80%. It's an on-market transaction listed by someone such as yourself. We're not going to have the requirement for evaluation.
I think we mentioned before that we've mentioned FOOP before.
Yes.
Fear of overpaying.
Fear of overpaying.
And FOMO, fear of missing out.
Yes.
And it's tilting again, isn't it?
It really is. It's just sort of like someone's jumped off the seesaw. It's gone boom. All of a sudden, people are being forced to question, do I pay more for this house because the competition is driving the value up, albeit at a lower interest rate, or do I pay a little bit less now, get in now before the prices arguably skyrocket, which of course is what the Reserve Bank doesn't want to happen.
No.
But
it's not just the case of the price going up, it's also a case of competition.
Exactly.
And the market's going to be working faster
absolutely
come the springtime. And I guess the other side of it is that up to now, in the last few months, it's been a case of a happy price, a grumpy price, and
some
the
sort of
sensible price in the middle.
Zone in the middle there. Yeah, absolutely.
and I relate it to the Seven Dwarfs. You got happy, you got grumpy, and you got Doc, the sensible one in the middle.
Yeah, totally.
And I was telling somebody about this about a couple of weeks ago, and I was saying at the moment the vendors are having to look at their grumpy price, and the purchasers are having to look at their grumpy price. And if those grumpy prices coincide, then there's a deal.
Absolutely,
You know?
absolutely. Listen, I don't want to get into politics, and I'm not suggesting for a moment that I'm a big fan of Donald Trump, but I did buy one of Donald Trump's books years and years and years ago. It first came out, and it was called How to Get Rich or something along those lines. And one line in it, and it's the only line I can recount, suggested that a successful business deal is one where both parties walk away feeling like they lost. And I thought that's a great way to look at it. Again, this is Donald Trump we're talking about. And it's nice to think that, both parties are happy. Yeah, okay, that's a great outcome. But if both parties feel like they gave more than they got, it really is a sign that the best price was met. And that's why
you can hope to achieve the market price being better than what it was 6 months ago.
I think one thing that we failed to, and it needs to be addressed, this doesn't just apply for buyers. Vendors need to understand that if they get an offer that is close to their grumpy price, maybe a bird in the hand is indeed worth two in the bush. It could mean the difference between them being able to buy the next property that they want to now, or waiting 6 months and having to pay, because of the increased competition that they'll be up against, having to pay tens of thousands of dollars more. Again, albeit at a slightly lower interest rate. The choice is yours. Do I pay more at a lower rate or less at a slightly higher rate? We're seeing some great rates out there now. 3, 4, 5 year interest rates all below 6%. Not recommending that people do fix for 3, 4 or 5 years unless their situation calls for it. Generally speaking, we're still favouring 6 and 12 months.
Right.
Yes, I do still think that in 6 months' time, rates will be lower than they are today, but I don't know when they will be at their lowest. I don't think that's going to be in 6 months.
No crystal ball.
Correct. The question is, do we fix for 6 months and then another 6 months and then another 6 months, bearing in mind that the 6 month rate is the highest of the options right now, or do we fix for, say, maybe a year or even 18 months and hope that brings us off our new fixed term when rates are at their bottom?
Okay. There was another quote from our friend Donald Trump, and it was, don't wait to buy property then wait.
And then wait. I like
because
that.
the price is going to keep going up.
Yes.
No matter what you do, the price is going to keep going up.
Yes.
We saw a drop around 2021, 2022. People bought at a high market, now they're trying to sell, and they're having to take a hit, unfortunately. If they wait another 2 to 3 years, we'll be back on track again.
It's purely microeconomics. I remember when I bought my first house, I won't say how many years ago because that'll give you an idea of my age, but we bought our first property and I actively monitored its value. I was able to get access to QV were offering e-valuer reports, estimated market value reports, and within a month or so my house value had dropped by $20,000 and I was despairing. Within 6 months it had dropped by $80,000. Oh, this is terrible, this is horrendous. But someone said to me, and it's a statement, a quote that I still use today, a house is only ever worth what someone's prepared to pay for it when someone's prepared to sell it. And I realized there and then that what these microeconomic day-to-day values mean is nothing.
Yeah.
And I was able to put that into context a few years later when my sister and I sold my father's house in London. Now, he'd owned that house for 40 years. And it had gone up by about, I don't know, it's about 100 times. It's about 100 times in value.
Wow.
Right?
Well, it would be over that period of time.
17,000 up to, 1 point something million. It was incredible.
Yeah.
It was incredible.
When you could buy a bag of chips for 2 pence. Yeah.
The point being that when I zoomed out and looked at, okay, what is £17,000 doubled in 10 years? And then what is that doubled in 10 years and doubled in 10 years over the course of 40 years? It wasn't far from it.
No.
And so I was able to see in real dollars and cents a tangible transaction showed me that yes, properties do value every 10 years.
Yeah.
You just, if you pick this month and that month 10 years apart, it might not. But over the course of 40 years or longer, don't wait.
I guess the people that haven't done very well out this whole period of time have been the ones that flick properties.
I was going to say the speculators.
Yeah, the speculators, they buy it, they do it up, and then they flick it on.
Yes.
And the profit hasn't been there for them.
No, that's absolutely right. And there have been factors arguably outside of our control. Things like the foreign buyer ban, for instance. Suddenly the market, the people that I can sell my property to is vanished or but vanished. The removal and recent reinstatement of tax deductibility for interest, things like that. When that ability to claim the interest costs as a tax deductible expense was removed, the market, our options to sell dried up. Supply and demand 101, the value of your property reduces as your market shrinks. As we were saying just a short while ago, this perfect storm. We're now able to claim the interest as a tax deductible expense. These perks are all coming back in again at the same time as interest rates are coming down, and we're headed into spring. It's some crazy times lie ahead, and I just need to stress that turnaround times, response times are going to suffer for it. Please, any potential buyers that you happen to, anyone that's looking at properties, make sure that they are approved, they're getting to their bank, make sure that any approval that they have or they think they have is valid and current. They do lapse after 90 days. We can quickly and easily reinstate them, but once they have lapsed, we then have to start over again.
Yeah. And with the market picking up and becoming more rapid over the next few weeks, preparation is the key, isn't it?
Absolutely.
Dot all the I's, cross all the T's, have it all in place so that if something does come up that's your dream home, you can bid at auction. You don't go into a multiple offer unless you have to, because it's the worst position to be in as a buyer.
Absolutely. Make sure that you're putting your best foot forward. I feel that right now, and perhaps for the foreseeable future, the days of taking our time and negotiating and leaving them on tenterhooks, I just don't think we're able to do that. I've had 2 calls today from conditional buyers who have been told that their escape clauses have been invoked and they now need to declare that their purchase is unconditional because backup offers are coming in. Don't leave it until it's too late. No. There's nothing worse than getting a call from someone who I've been working with and talking to, but not really doing much with for 6 months, a year or so. Saying, I found a house and it goes to auction 2 days from now. We can't turn things around that quickly. Just get it approved. It doesn't cost anything to do. It doesn't hurt. You'll know how much you can buy for. It will change your view on what to look for.
So I guess the question is, the OCR came down 0.25. Is it likely to carry on coming down this year?
Yes. Depending on who you read and who you believe, I think I'm right in saying the consensus is that we're going to see at least 1 more, if not 2 more cuts before the end of this year. Now this is uncanny because just back in May it was suggested that we would not see a single cut. We may even see a hike until next May. So this has been a complete about turn. There are a number of justified questions being raised about why the data which Adrian Orr and the Reserve Bank used back in May was so out of touch with what we've all been seeing in the market. Since February, I've been crying that my clients are losing their jobs. People are being made redundant. This economy is really hurting us. And yet, because the data wasn't filtering through to the Reserve Bank, we kept on threatening to increase interest rates. We won't dwell on the past, but the point being that ASB cut all of their floating rates by 0.25%, which was the amount of the cash rate cut. It was really pleasing to see. Oftentimes when a bank lowers its interest rates in response to the Reserve Bank changing a cash rate, they take a little bit of margin, a little bit of cream off the top. So seeing a full 0.25% reduction was really, really good. I think if we do see another cut in October or in November, we can expect to see more of the same. What I'm really, really looking forward to seeing, though, is those 6, 12, 18-month rates dropping down below that sort of 6% mark. That's going to mean, yeah, okay, we're about there. And I dare say that when that happens, hopefully not if, but when that happens, those longer term rates will suddenly start to be a bit more viable too. You know, if we can get 3 years under 5.5%, that might be worth considering as part of a balanced loan structure.
I think you're right. There was a bit of a lag in the information coming through for them to make a decision. And it's the same all over with real estate, that we're seeing things and then it's being reported in the media 6 weeks later.
Absolutely right.
Because it takes that long to filter through the stats.
Absolutely. I have fond memories of frequenting the Barfoot and Thompson auctions at the Bruce Mason Centre in Takapuna when I was first getting into this, and into mortgages, and I saw that the activity was there. I'd see that everything was selling. This is years and years and years ago. It was so buoyant, and you'd be reading in the paper, it was a subdued market, and sure enough, 6 weeks later, the properties which I'd witnessed being sold under the hammer were settling. A few weeks after that, that data was filtering through to the properties register, and then that in turn, so it could be a couple of months before we were finding out how good things had been 3 months ago. It was crazy. I think it's really important for anyone that's thinking of buying properties, go to an auction. Even if it's a property that you're not interested in, just attend an auction. It may be at the Bruce Mason Centre, it may be on site, it may be at the local real estate offices, but be there and see what happens and engage the activity out there. You're far better positioned having seen how these things work than going in to your first ever auction with a view to bid. It can be heated.
Right. And the auction rooms at the promenade now, because it's moved across the road, they can vary from week to week.
Of course.
The actual sale under the hammer. However, when you look at the sales over a 3-month period, we're now back up to about 69%.
Wow.
And that's not under the hammer. That's either sold pre-auction, during the auction, or after auction. And because up to now there's been so many people that have been conditional, or the banks have been making them wait for valuations and building reports, it's delayed the sale process until after the auction.
Right. Yes.
However, that auction process has still generated the urgency from buyers coming through. What do they want? What do they want? Well, you're going to have to wait until the auction to find out.
Absolutely. Yeah, I mean, I do deal with clients who, for whatever reason, you know, oftentimes they've gone out, they've got valuations, they've got building reports, they've got themselves ready to bid at a property only to see that it gets passed in, or they get gazumped and outbid, and they're a little bit sort of once bitten, twice shy. Those are the guys that will attend an auction just hoping that it gets passed in so that they can then go and present their best offer, and you know, it's quite sweet. Again, I feel like there's going to be increased competition out there that doesn't afford people that luxury of sitting on their hands. I think now's going to be the time for action. I really do.
Absolutely.
Yeah.
Well, Glenn, really appreciate your time.
It's a pleasure.
Keeping the finger on the pulse does matter. As you can see, we made the prediction on the last one that it's likely to come down, and it did. Economists were saying, no, it's not going to come down until at least October, November time. And I think probably as well they were basing their facts on the American elections as well, because that has a big bearing on what happens in the world.
Boy, what a curveball we've seen there. You know, that's completely changed the outlook for the States as well. Again, we won't get into politics, but there's a lot going on at the moment that is somewhat exciting, and again, the sentiment is fast changing. It's been a long time coming. It's very welcome, but yeah, people are eager to get out there and go. So we just need to make it happen for them.
Yeah. Okay. Thanks, Glenn.
Cheers.
Thank you. And if you're looking for more information about home loans or the property market, please give Glenn a call or myself. The number should be at the bottom of the screen. Thank you.
Cheers.